Back to Wall Street, stocks eventually recovered as investors chose to focus on whether the jobs report meant the Federal Reserve would push back the start of its bond buying program. As a result, the Dow wiped out a nearly 150-point loss. In the end, the Dow lost only 15 points on the day, but finished higher for the week. The Nasdaq rose by a point, and the S&P managed to eke out a tiny fractional gain. The concerns over Syria sent oil soaring more than $2 a barrel, settling at the highest price since May of 2011, $110.53. And the U.S. bond market rallied with yields on the benchmark 10-year Treasury note falling back below 3%.
And Susie just mentioned that 10-year yield below 3% once again. That has ramifications for a lot of things. But what does it mean for you? Michelle Caruso Cabrera explains why 3% matters.
When Wall Street talks about the 10-year yield hitting 3%, what that means is the U.S. government has to pay 3% to borrow money for 10 years. And that level matters because so many other loans for consumers and businesses are connected to it. Mortgage rates, credit card rates, car loans, business loans, they're set at an interest rate based on the 10-year yield. So when it goes up, those rates go up too. We've already seen it in mortgage rates. Freddie Mac says the average 30-year fixed-rate mortgage is now 4.57%. A year ago, it was only 3.55%. And that means if you buy a $200,000 home now, your monthly payment is $94 higher than if you had bought a year ago. The 10-year yield hitting 3%, the highest level in 2 years, also impacts stock portfolios in significant ways, because that higher interest rate provides competition to other kinds of investments that pay dividends or interest. That's because despite all the controversy about how much the U.S. borrows, the U.S. government's debt is considered one of the safest in the world. In other words, you're extremely likely to get paid back. And because the U.S. government is paying a higher, more competitive interest rate, many stocks that pay dividends have fallen or not advanced as much because what they pay isn't as competitive. Also, corporate debt that pays a high interest rate, what's known as high yield or junk bonds, those have fallen in value as well because they're seen as less competitive. The good news about the 10-year yield hitting 3% is that many believe it is going up because the U.S. economy is getting better. For Nightly Business Report, Michelle Caruso Cabrera.